though it's hard to make out from the background. I can only see a few pictures, but I hope all of you are together, and these 24, 36 months has been kind to you and to your family. With that said, let me get on to the topic. What I want to talk about today was, just my thoughts on, what's happening in banks today. And for that, I'm going to base my comments on a report that comes out once a year. This is the McKinsey's global report on banking, which they release every year. This was released, I think, the latest report is one dated December 2021. And, there are several months have passed into 22, but I think some of, what they hold as trends and the challenges is so true. And I thought maybe this could be a good way to get all of you who are, some of you may already be converts, would love to have a career in the financial services industry. Some may not. My hope is that by trying to set out the challenges in our industry and what beckons in the future, I hope to draw some of you who are on the fence to also come and join in this industry. I want to talk about maybe 15, 20 minutes, 30 minutes at tops. And then what would be useful is if we could have a round of questions. It could be comments on what you just heard, or it could be comments on top of your mind, or questions. And those questions could, cover a vast range of topics. Need not just be in banking. It could be about your career, how to land the first role, leadership, anything that's top of your mind. So with that said, let me start. Whenever we talk about future, I think it will be a good idea to try and anchor ourselves in the past. And we just, talked about how these last 36 months, one of the topics that we've all stayed current is the pandemic. And, in my career, I've also been, in hindsight, I can say fortunate, but going through it at that point in time, it didn't seem like that. We also saw the crisis of 2007, 2008. I was leading the retail business for Barclays at that point in time. And I think if I were to just use that as a time marker, basically use the years of 2007 or 8, 9, and 10 as a basis. And if you compare the state of the banking industry at that time vis-a-vis now, I think we can make a few comments. And I thought maybe that will be a good place for us to start. First and foremost, I think at the back end of the financial crisis, what was happening was banks were, in fact, in the Western world, clearly, the roots of the crisis lay in the banks. And, many, not just the public, but regulators across the globe came together to try and redefine what kind of businesses the banks ought to be in and what capital they might need to allocate should they be pursuing these business lines. So one of the things that happened at the back end of the financial crisis was this Basel II, Basel III norms that got released, which requires a certain higher level of capital to be kept for, risk act, depending upon the risk entailed in activities, for example, the investment bank or trading, compared to, let's say, the traditional banking, lending to individual clients, etc. So, the risk profile is different, and therefore the capital requirements for these were also requested to be changed. And then, one of the things apart from higher capital was also, banks because they faced the wrath of the regulators, the public, etc., took a lot of time to try and mend their regulatory fences. I think it was clearly the case that many of the banks were sailing close to the wind, and it required a complete relook of the risk and controls environment within each of these banks, governance. It became such a hot topic. Some of the, I'm not too sure how much you folks have been following, but something called the senior management regime, where there was individual accountability assigned to the senior management in banks. I think these were all par for the course coming at the back end of the financial crisis. And what also happened was, there was a, if you just look at the years that have gone by, the past 2-3 years, one of the secular trend we all see is this investments to digitize operations. Yeah, be it client experience, be it internal operations. I think that is a place where lots of banks, banks have spent a lot of time trying to put together investments that will help them digitize and scale. And because of high capital, the fact that the business was getting commoditized, return on equity fell through this period. And what I want to do is I want to motivate this using some slides that I have borrowed from the McKinsey report. So I'll just share screen. Give me a minute. In case you folks are not able to see it, please shout out, one of you, if you could unmute and let me know. That will be kind of you. So I'm just going to share screen. Are you able to see this?
Yes, sir.
Okay, fantastic. So if you look at the two charts here, the left-hand side chart is a metric called return on equity. Maybe let's kind of pause here and just find out whether people understand this term. So can any one of you tell me what ROE or return on equity means? And think about this in the context of a bank. So what is ROE? Anybody, please? Come on, folks. Not a trick question. It's a simple question.
If anyone would like to answer on the chat box.
Yeah, so it's basically a metric which shows a relationship between a company's profit and an investor's return, right?
Exactly. Which is basically, in the denominator, you have shareholder equity. In the numerator, you have net income after taxes. Yeah. So essentially, this is in the past, maybe a different way of motivating would be is maybe to the same gentleman who answered that question. If you think about a bank, what is more, or any company for that matter, what do you think is more important, growth or profitability?
I believe it would be growth, because as far as you are growing, then
as far as you're growing, profits can take care of itself.
Yeah, basically.
Okay. So without wanting to be dragged into a controversy, some of the startups, that you see today, many unicorns, they are still to turn black, but they have huge valuations that put, traditional banks like us to shame. So I can see that you are from that camp where you believe, growth will take care of profitability. So this return on equity metric is a profitability metric, and this, without getting too much into the conversation between growth and profitability, there are different industries and in different parts of the banking, different investor groups which value each one of them differently on whether it is growth or profitability. Maybe that itself is a topic for a full lecture one of these days. Maybe we should get around and talk about that. But I want to motivate here that the parameter that McKinsey has used is return on equity. And they compare two periods, right? The period just after the crisis, which is 7, 8, 9, and 10, 4 points, the black line, where you can see the ROE was 16%. And by the end of 2010, this was pretty much around 9%. And this, shall I say, shrinking of ROE profitability has been because I think it required higher levels of capital to be kept by banks. The focus on trying to get the shop in order, and the fact that over time banking became very commoditized because I think there were prescriptive rules for everything. And some of those exotic and high risk stuff that banks were doing were either no longer permitted, for example, proprietary trading, or if banks were involved and engaged in it, it required very, very high levels of capital. And because ROE as a metric includes equity, capital as part of its denominator, you can actually see the compression because of that. So the first thing one can notice in this chart on the left is that the ROE between the pandemic time and if you were to compare it with the financial crisis, you can actually see that pretty similarly. I think once the pandemic kind of hit us full blown in 2022. So this is 2019, 2020, 21, 22. Yeah, 4 slides. And because this report was written in 21, and at that point in time, we were still estimating a return. So that is why the dotted lines. Yeah. So one of the things you can easily see here is that while ROE, so if you look at this 9% level, that's where it was started pre-pandemic. And it is expected that by 2022, we will go back to pre-pandemic levels. Yeah. But the important point here to note is that, when you compare to the dramatic drop in ROE at the back of the financial crisis, I think the COVID-19 crisis has not been all that bad. I think that's the first point that, McKinsey makes in their survey report. Yeah. And, this is true for Indian banks as well. And I will motivate that a little bit more as we go through these slides. This one, Tier 1 ratio, is basically, a measure of capital, what people call as core capital. And again, if you look at it during the, financial crisis, thanks to Basel II and III, it required higher levels of capital. Banks now generally have higher levels of capital to take care of any exigency. And, it is expected because of, some pressure in terms of, non-performing loans, etc. Again, broad brush, it is expected that it will either be flat or slightly lower. Yeah. So I think the key takeaway for all of you here is the headline that the COVID-19 pandemic's impact on profitability has not been all that bad. Yeah. So that's the first statement. Now, McKinsey has broken the ROE chart that we saw by region. Yeah. Again, I'm just skipping it. I will, at the end of this session, send Jainam, the link to this report. Please do have a look at it. I think it has got lots of data supporting it. But essentially, the message here is that if you think about some of the markets, they have been more adversely hit compared to some other markets. I think that is what this makes. So if you think about Latin America, you can actually see how subdued the ROE charts are compared to the financial crisis, at the back end of that. If you were to look at the Middle East and Africa, very much similar. Middle East, and so this is the chart I was referring to. If you look at Europe, pretty similar to that. Yeah. So this is just a granular level view by region. Yeah. Nothing much for here. for me to comment on. This is the issue, therefore. Yeah, so in the headline, what we said was that if, since 2010, banks have been shoring up their capital, they've been doing less risky business. And this COVID pandemic hasn't impacted their profitability all that bad. So, what is the issue? This chart actually highlights the issue. The issue is that more than 50%, that is 51% of the banks have return on equity lesser than their cost of equity. So can somebody be kind enough to tell me what cost of equity really means in the context of a bank? What is cost of equity? Come on, guys. Anybody? What is cost of equity? It's not a trick question.
Return a company requires, like the profit that it requires from an investment.
Return that a company requires or a return an investor requires?
Investor.
Exactly.
One who put
Exactly. You said it right. So this is based on shareholder expectation, investor expectation, and that is typically drawn from what the opportunity cost is for that investment. The way to motivate it is I, as an investor, could either put my money in a banking stock, pick a name, JP Morgan, or I have other choices, Apple, Google, etc. So the return that I forego by taking that money off an alternate investment and putting in this specific stock, is the cost of equity for the investor, which is a return that one would expect. And that and from a company perspective or from a bank perspective, that is what they should, at the minimum, be able to generate from the capital that the investor has given them. Yeah. So rough handle, the cost of equity for global banks is in the 8 to 10% handle. And we saw in the earlier slide that the return on equity, if I go back here, the return on equity, if you look at the blue chart, this is roughly around 8 to 10%. So 8 to 10% on a cost of equity also of 8 to 10% means, it is no surprise that about 51% of the 900 banks that McKinsey surveyed, they were actually returning, the return on equity was far lower than cost of equity. In fact, in their actual report, they say that 17% have their cost of equity at least 4 percentage points, that is 400 basis points higher than the returns they're able to generate. Yeah. So this is the challenge facing global banks.
Sir?
Yes?
I think the slides aren't updating.
Okay. Let me do one thing. Let me stop sharing and come back in again. Just give me a minute. I will try to share again. I think if I go back and forth, I think it just gets, the bandwidth gets clogged. Are you able to see, folks, now?
Yes, sir.
Okay, fantastic. Okay. Yeah, so let's keep going. Yeah, this is challenge number 1. What is the challenge number 2? You folks might have heard of price to book and price to earnings ratio.
I
Right?
did it. Janam Mother Chod. Janam Mother Chod.
Hello?
Sorry for the inconvenience, sir. Someone just messing around.
Okay, so shall I continue, please?
Yes, sir. Continue. We take them out.
Okay. So the second challenge, if you see, is the banking price to book ratio. And if you look at it, it is less than 1. What does that mean really? What is the price to book value? And if the price to book value is 1 or less than 1, what does that mean really? Anybody?
So the book value is the value of company's asset, right? And price to book value would be the ratio of the market value of a company to the value of its assets, basically.
Exactly. Market value to book value. I think that's the simple ratio. Yeah. So if it is less than 1, what does that mean really?
It's undervalued. The company is undervalued.
Company is undervalued. So is it time to buy
So
or is it a bad sign?
it might mean a number of things. It might mean the market hasn't found the value of the inherent value of the company, or just that the market in which the company is currently present in is doing a bad time, or it might be some internal problem that the company might be facing. A number of things.
Very, 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 very well said. And I think I'm looking at this as a problem because I'm comparing it within banks here, or McKinsey has compared it. So, if you look at all other industries, they've got some comparison. But if you look just at this chart, it is comparing banks over time. Yeah. So, essentially what this means is that, assuming it's not always the case, but typically if you have in bank, I think one of the things that we tend to do is we tend to mark assets to market value. Yeah. So if the book is updated to market value, then if you compare that with the price, and if it is still less than unity, what it means is that the investors believe that the quality of the asset, they are not comfortable with. Yeah, as this gentleman said, it could highlight a number of different things. So context is very important. So I'm generalizing here when I say that a price to book ratio less than 1, especially when you compare it with the broader economy, means that these stocks are trading at a significant discount. Yeah. So essentially, I think these two notes at the bottom, I think the impact of excess capital is basically saying that, after you take into account the ROE pre, shall I say, Basel, and then post Basel 3, this is the incremental return that has been lost because of this excess capital that banks have been required to have. Yeah, this is just a way of trying to say, okay, the return is lower, price to book value is lower. Can I understand the component parts as to where it's coming from, this undervalue? Yeah. So for that, this is just an elaboration of that point. Yeah. So this is the second issue. So what have we covered thus far? First thing we said was, if you looked at the overall ROE, it appears that this crisis has been relatively benign for banks compared to a huge amount of capital calls, few banks going under, some white knight acquisitions in the past, regulatory censure, etc. During COVID time, we didn't see all of that. In fact, banks were a part of a problem. So then where is the challenge in the banking industry today? So it's coming in the form of two things. One is that the ROE is depressed. It is not even covering the cost of equity for more than half the players. The second thing is the banks stocks are trading at a significant discount when compared to the larger economy. Yeah, so that's what we've covered. I'll just skip this. All of this you can see in those in that report. Yeah, this slide is pretty interesting. Yeah, one of the
So
things.
this,
Yeah, again, I think you're not
yeah,
able to see the screen, are you?
yeah, it's not updating, sir.
Okay. I'm suffering from poor connectivity today. Just go back, a window, go back here, share. Are you folks good with it now, please?
Yes, sir.
Okay, okay. So if you think about what's happening, and I think we mentioned that a little bit earlier when we talked about profitability versus growth, and I was saying that from a valuation lens, we have several unicorns which are still to turn black. In fact, this slide actually articulates that in a different way. It kind of says that in the period between 2020 and 21, in the banking industry, the market cap increased by about 1.9 trillion. Yeah. And if you look at where this market capitalization, the incremental market capitalization have gone, this chart kind of says that much of that has been picked up by new firms, fintechs, yeah, those which are focused on payments have got valuation of something like 400 billion. Securities and investment banks, this is the Robin Hood. I don't know how many of you have been following the story of some of these broking houses in the US. So these are some of those. So essentially what this slide kind of says is that if you think about market cap, ours is, Barclays is a classic example. We are a 330-year-old company. Our market cap is roughly about 30 billion. But if you think about some of the new age companies, so for example, in the US again, there is a bank called Silicon Valley Bank. It is one of those new age companies that is focused on the innovation economy, as they call it, which is focused on fintech startups, both in the health space and in the financial services space. They have market valuation. They have roughly about 20 years, 30 years in existence. They have market valuation, which is close to what Barclays is after 330 years. Yeah. Another stark example could be, I know how many of you have heard about a company called Square. So Square is very much like our Razor Pay or Builders. This is focused on the payment gateway business. That is just about 10, 12 years. Those companies like, Klarna, Squire, Adyen, these guys are enjoying valuation almost close to the 20, 25 billion handle. Yeah. So something has changed in the market. If you look at this chart from McKinsey, it kind of, same story, which is if you look at earnings to book or price to earnings or price to book, market does not expect too much from banks in terms of their future. Yeah. This is under the assumption that price in some sense subsumes what the market is able to see in terms of the future. Yeah. So all information is captured in the price. If you agree with that, then this is a view of the world. Yeah. So folks, this is where the industry is. Pretty challenging times. We've learned a lot from the crisis, but currently we are suffering from a significant discount in terms of where our stocks trade. And the second one is, we have problems in terms of trying to provide a return that is, reasonably above the cost of equity. Yeah. So this report goes on to kind of talk about many different things. I will pause here because we've already spent about 20, 25 minutes. Maybe as questions come, I can kind of talk about, okay, so what are some of the things that the banks are doing? Kind of questions I can respond to. If there is something else that comes, comments that you have on, if you have seen this report or basis what I've commented thus far, if you want to prognosis what lies ahead, by all means, I would love to hear your views as well. Yeah. So maybe let's take a pause here for a quick round of questions before we press ahead. Yeah. So Jainam, let's open the floor up.
Yeah, so if any of you have a question, just put it in the chat box. And before that, we have a few questions which we got from the Google form we sent out.
Okay.
So someone had asked that how can one know if he or she should pursue finance as a career option?
Okay. I think, it is no different from how we make decisions elsewhere, right? This is a decision about a career. It could be a decision about which institute to join, which course to join, etc. So it is largely based on interest. And that interest could be one which is germane, intrinsic, because there's somebody in the family, there is something that you read up that caught your attention, etc. Or it could be because you aren't aware of what's happening in the industry, and therefore conversations like this where you get a perspective that could perhaps force you to think would increase your interest levels. Yeah. So I think, how do I choose to enter one industry over the other? I think the first and foremost I will think is interest. You have to have some degree of passion around it. And the second one is, whether you feel whether this is an industry that, when I put this price to book chart, one can see this as doomsday. Some other people can see this as opportunity, as a challenge. Yeah. So it again depends on, apart from interest level, is whether you want to join a sunrise industry which has got a different set of challenges, or you want to join a mature industry which has got a different set of challenges. Yeah. And typically, you could get your mind blown away by the choices that you have. If not in financial services, it could be consulting, it could be entrepreneurship. As they say, the world is an oyster, and the best way to do it, I think, is to take an experimentation view, which is try and get into something, see whether you get a good feel for it, whether what you thought would be interesting really does it turn out to be interesting, and then you can pivot your career around that. It is no different from how entrepreneurs launch their companies, right? You have an idea in mind, you think it will work, you go and create a prototype, you test it in the market, and based on the reaction, you kind of move it around a bit. Yeah. I think our career is pretty much similar to that. I joined the industry some 30 years ago, and this was a case of being an accidental banker. I wanted to teach. I had finished my program, and I had gotten back home. I find an interview letter from Citibank. Because this was in Chennai, my relatives stay there, so I wasn't too much interested. But just because I wanted to go and see my relatives, and these guys were anyway paying for the airfare, I kind of went to Chennai. I did well in the interview. I decided to join, and I have not looked back since. So it could be a case where you have no other choice but to join the financial services industry, and you take a liking for it. Yeah. So yeah, it's an interesting question that you ask. There is no right answer. My sense is, have a spirit of experimentation. I think you will do well.
So I think another question I got related to that was, what are the micro skill sets one should cultivate from a young age, such as college first year, that will help him or her establish a successful financial career?
If you could repeat that again, what skill sets?
Yeah.
Okay. So, in skills, on the skills and competencies side, there is lots now being said about the future of work. I will borrow from some of it from there. I think one is certainly a degree of comfort with technology, how it might possibly help us solve problems at scale. I think that natural affinity, understanding, I think could be pretty useful if I think about the industry in the future. Ability to um, don't need to necessarily be very adept or conversant with numbers, but I think being analytical, I think is one of the skills that I value quite high in terms of people who will do well in a career in finance. Yeah, so the ability to understand. I mean, uh, when I said ROE, price to book, I mean, simplistically, also you could understand it. But if you want to get deeper into it, into what the levers are, what impact. In fact, McKinsey had done some work like that, which is to say that for every 100 basis point increase in interest, what is the impact on ROE? So those are all, if that's something that comes naturally to you, the ability to think analytically and critically, look at things, I think you will possibly enjoy the world of finance. Communication, articulation, I think it's a basic competency. Increasingly in the future, it is going to be very, very important. And one of the things that has been talked about very, after the pandemic, it has kind of taken a life of its own, but something that many of us who have kind of traveled the distance over 3 decades, I think, have valued is this skill or trait for empathy. I think you don't get into bank, or you don't get into a career thinking that you will make money. You get into it because you want to be of service to others. In fact, I remember my first interview at Citi. In fact, the gentleman who is now holding a global position with Visa International. I think his question was just that, which is, what do you think differentiates all of you who are graduates from some of the top institutes? What do you think is your distinguishing, or what's your edge? And I think this ability to think about a career, think about what we are doing as relevant, as wanting it to be relevant for others. So this purposeful companies or meaning at work, all of this has gained a new lease of life after the pandemic. Yeah, when one has gotten in touch with how fragile human lives are, but that has always been important. Yeah, so communication, analytical skills, a flair for technology, service orientation, I think these are possibly very, very important.
So the last question I have from my end from the Google form is, as a banker, what do you think are the best practices one can follow as a customer to ensure maximum benefits from banking?
Yeah. I think, this is possibly what our grandparents might have taught us, which is don't live beyond your means. I think it's something so fundamental with all this craze for buy now, pay later, over leverage. In fact, leverage itself is a concept that I think in the world of finance is so fascinating. We talked about the crisis, and one of the main drivers for why we ended up in that scenario was over leverage. People, so leverage. The way I'm talking about this is, if the return is going to be higher than the cost, then it's fine. You can move that along. So leverage makes sense only if your return is higher than the cost of leverage, or cost of additional borrowing, or cost of borrowing. And that one has to keep in mind. Yeah. So I would think, not just for into the world of finance, but as a client, as a customer, first and foremost is to be clear that you're not living beyond your means. So this is a story from the grandparents' side. Yeah. The second skill as a client, one of the things that I feel, that is very important is, trying to understand how this can be of use, how you can use, let's say, products and services offered by the banks to make your life easier, comfortable, etc. So the concept of, if I said maturity transformation, would you folks be able to understand? So essentially, what do banks do? So I have some excess capital as an individual. Say I put that in my savings account, or I put that in my in a financial investment, let's say stocks, mutual funds, etc. And what is my hope? My hope is that it grows, and when I really need it, I'm able to get it back with those returns compounded, right? If you think about from the bank's perspective, you think about how these deposits are all callable, right? So if there is a run on the bank, we saw that during demonetization time, where customers were wanting to withdraw money from the banks. So if I had taken money from the customer and I have used that to fund long-term assets, like let's say a mortgage, how do I manage the short-end callable funding to manage a long-term asset where I can't reprice it, as I wish, right? So this is called maturity transformation. Yeah, I think it's an important role that banks play. And as customers, I think if you understand that as to how you could use your short-term funds to be able to grow it and create a financial nest egg for you in the later years, that's a valuable lesson too. The rule of compounding. I think that's one of the, there are whatever 8 wonders, 9 wonders of the world. I think I would think that even the magic of compounding is one of the biggest wonders in our world. So starting small, starting early, and letting the investment compound so that the maturity transforms, I think is an important role that financial services players can contribute. So as a client, knowing that is very important. Yeah. So don't live beyond your means, and think about creating a financial, nest for yourself for future years. I think could be what customers should look out for.
Okay, so the next question I think we have from Molly is, how are banks facing new digital competitors such as fintech companies and technology giants like Apple and Google, which started their own payment services?
Yeah. I think it is one where, like I said, and we saw that as well, right? So what's really happening is it's pretty interesting. If you look at the traditional bank, the banks make money, like I said, you take money from somebody who has surplus and you lend it to somebody who is in need. And you make a spread between these two. So one is the cost of funds, the other is the return from customer for you, and the difference between this is net margin. Yeah. And if you think about traditional lending businesses and you look at the ROE for those type of businesses, that ROE comes in the range of, again, it's there in the McKinsey report, something around 4 to 6% is what I recollect seeing. But if you look at the new businesses, which is capital light, so you think about it as payments, you think about this as distribution, think about this as advisory, where you don't have capital locked in, there your ROE lifts up. Yeah, and those ROE, the ROE profile for those type of businesses is in the 20% handle. Yeah, so the challenge for banks is our traditional strength has been in lending. How do I combine that in a capital is going to be scarce, and with all the regulatory rules and clauses, the type of activity that you want to do requires very high capital. So your return therefore is depressed. So how do I take this traditional business model and convert that into, you mentioned technology companies, I think is an art. And I think that has been the endeavor. So lots of things are going on. Many models exist, banks buying companies, banks creating an ecosystem, banks trying to take their customers. Thus far, it has only been financial services products that they have opened up to their clients. Now they are trying to see, can I go and create a partnership with other ecosystems where I can provide value-added services for clients who thus far have only seen their financial services wallet. For example, this could be something in it could be related, it could be completely different. For example, travel, etc., could be adjacent. But if you think about education, advisory, etc., it's little, right now feels unrelated. But those are value-added services that you could bring to your clients. So many such experiments and models have been, we have seen in vogue, and we'll have to wait and see. Yeah, I think right now the big theme everybody has is, do you have any proprietary insights on clients, either clients within your ecosystem, that is not just with you, with your partnership network, or something that you can get from others, using which you could create a business model of new value-added services. I think that's the holy grail. It sounds, it's easy to say, but it's hard to get there. Yeah, so that requires, first of all, good data. It requires analytics capability. It requires the ability to create an ecosystem. It requires the ability to monetize that ecosystem. So, life is tough. Life is tough. Yeah, so it's not easy.
So another question we got is from Surya Narayan. So he said, "What do you think about private credit industry?"
Private credit. Yeah. It's I think if you think about the various segments in which banks, so one of the things that the McKinsey report talks about is this great divergence. What they're saying is that if you look at, in the last 36, 48 months, what has happened is the gap between the top 10 performers, the first decile, and the middlers and the bottom end has just widened. The question, the way I'm going to be answering this question is just that, which is, if you think about, just give me 1 minute. Just give me 1 minute. Somebody is trying to lock the door. Just give me 1 minute.
Sure, sir.
Sorry, I lost my trail of thought. Jainam, if you could just repeat that question again. So
It was what do you think about the private credit
private equity,
industry?
private credit markets. Yeah. So we were talking about this divergence, right? So one of the things that I find that is happening is, if you think about the spectrum of segments that you can, again, using the McKinsey report, there are 4 sources of divergence. Yeah, one is which geography you operate. So the emerging market premium versus developed market discount. Yeah, not really the case. It has its own web ebbs and flows. For example, at the back end of a crisis, typically there's flight to quality, so the developed markets tend to benefit. But if you think on a longer term basis, the emerging markets kind of return quite well. So one source of divergence is geography. The other source of divergence is scale. Specifically for digital businesses, if you can, even if it is a low margin, but if you can get scale, then that's another way to build healthy returns. Yeah, so that's another source of divergence. And the third one is segments, which is where I was going with this question on private credit, which is, where do you want to play? Do you want to play in the institutional side of things, advising corporate clients, helping them raise money, helping them fund acquisitions, etc.? Or do you want to be in the individual retail end? Or do you want to be a portfolio where you've got different geographies, different customer segments, etc., which is the typical universal bank? So coming back to this private credit, so one of the segments that have opened up in the last, whatever, 10 years or so, is this market on trying to fund companies in the innovation economy. In fact, there are several businesses that have been set up in the last, whatever, 1 or 2 decades that are going to be very successful. Look at the Silicon Valley Bank, for example. This is they started their business with just looking at financial services for new age companies, for startups. Yeah, simple model, basic commercial banking services. Then they moved up the value chain. Okay, I can help accelerate your idea, incubate new ideas. Then they said, hey, we can also talk to institutional clients who might possibly be good investment partners. So they've kind of grown their business. Yeah. So which client segment that you operate also has a large bearing on this divergence. Yeah. So private credit markets were hot. Right now, as has been the case where liquidity has dried up thanks to rising interest rates, etc., there's been a flight to quality. Some of these, liquidity has dried up, but that isn't to say that, the private markets have lost their sheen. In fact, much of, whether you look at acquisitions, whether you look at, new age innovation economies, etc., much of the growth is being fueled by private credit. In fact, I have some estimates somewhere in my notes about there's something called dry powder, which is basically capital that that exists in the private market that is looking for the right investment. Yeah, that number is staggering. Yeah. So, it only augurs well. There is very well-developed capital markets across the globe. I think, different markets, different stages of evolution. In our own country, I think the debt markets could be a little more deeper. But beyond the public capital markets, the private markets are also, pretty. In fact, if you look at the real estate industry, and if you look at the top 10 commercial real estate players in India, and if you look at the recent investments from PE firms, you will find all of the top 10 have now PE investments backing them up. Yeah, so it not only corporatizes commercial real estate in the country, but it also has professionalized that. Yeah, so yes, private markets are something to watch out for.
A question by Shubham is, how can an engineer, specifically manufacturing system domains engineer student, with skill sets of supply chain analytics and operation management, be a part of Barclays India and contribute effectively in the banking sector?
I think the gentleman is asking for a job. I think there is nothing like I have an applied science background. There are many engineers. IIT, IIM is kind of the shall I say typical investment bank profile. So you have all the right things going for you. And why Barclays, there is a we don't do, there are two businesses for Barclays. One is the commercial businesses that I lead, which is the corporate investment bank and private wealth business. On the other side, we have our shared service centers where we employ over 25,000 people. Yeah, our commercial business is relatively small. This is about 500, 600 people, so not much recruitments happen there. We don't get to campus in terms of large numbers. But on the shared services side, we do go to campuses and hire quite a large number. Yeah, so bits, etc., are part of the larger list that Barclays takes candidates from. So, there is nothing to say that an engineering background or a supply chain analytics person can't succeed in banking, leave alone in Barclays. Yeah, I think the world is truly your oyster. I think it just requires the right attitude, the right level of mentorship, and from your side, a willingness to put in the hard yards, yeah, in the early part of your career.
So we have another question from Surya Narayanan. He's asking, do you think, based on Barclays' current foray into the private credit industry, what are the challenges they would face due to a number of startups like Red in the space as well?
I mean, we just covered this, so let's
Uh,
pass on to the next question. I think private credit, we've kind of spoken. It's a hot industry. It has a long lead time. Um, you know, there are different segments. Yeah. So, what segment the bank wants to get in is an important strategic question, right? Um, so, if you look at global banks, it, the strategy has been one where we are diversified by geography, we are diversified by customer segments, we are diversified by any other geography. We said about client segments, products that we offer. So, our strategy, and we continue to believe on a universal bank strategy. But there are many who have done very well in taking a very niche focus to play. Yeah, SVB is a classic example. Though now I think they are also trying to move into a mid-sized bank. So if you look in the Western world, you have got lots of examples where banks specialize. There's something called community banks, where they are focused on one geography. So those are examples. They've also done very well. Yeah. So it's a one of a strategic choice, whether you have the resources, capital to be able to have the ambition and the aspiration to play in a wide geographical remit, or do you want to use your resources? Resources are always going to be scarce uh, in trying to win in a particular market. In fact, whenever crisis occurs, be it the financial crisis or be it the pandemic, you actually see that there is a retreat to your core business, there is a retreat to your core markets, where you have the right to win, so to speak. There are people who have historically been, shall I say, lucky to have a dominant position in a certain geography or location. So people tend to go back, yeah, because like I said, capital is scarce. Do you want to allocate that extra capital, which is very, very scarce, into your existing business, or do you want to put it in a new geography, in a new business? It's a one for the board to decide, right? It's a strategic question. There are no right and wrong answers, but there is consequences for both decisions.
so another question from Pranjal is, if someone wants to go into the research field of banking and finance sector, what are the opportunities and what should they do to get in there?
Oh, there's plenty of opportunity for research, folks. Yeah. So if you look at the traditional investment bank, you've got sales and trading. Then you've got the research wing. The research folks either, so there are two types, right? You either do fixed income research. Fixed income research is basically, think about this like an economist. Yeah, you have views about what the interest rate, what the currency exchange, macro view of the economy, and therefore how it impacts businesses. That's the fixed income research part of it. Then you have equity research, where you have people who follow specific stocks, and you could be on the buy side as well as or on the sell side. So depending upon whether you're writing the research report which somebody will be used to build their portfolio, that's one way. Or you could possibly be advising a client, in which case you're on the buy side. Yeah. So And what competency skills levels? Very similar. Yeah, analytical background, being comfortable with numbers, some experience exposure. So, for example, if you aspire to be an equity analyst, then some bit of experience in how this works, what drives value in a company, how do you, when we say markets are efficient, what's your thesis around that? It is these kind of things that typically come up when you appear for an interview for a research role. Yeah. So opportunities are plenty. Opportunities are plenty. There
So
are other types of research as well. Sorry, just if you go to a ratings company, for example, there also you have lots of work to do in terms of trying to understand from the profile of the company, basis conversation with the management of the company, just like you would write an equity analyst report, like that you would write a ratings report. Yeah, that is also, very similar to the research skills that you were asking for. It's a fascinating field.
So a question by Nikunj is, what practices this banking sector is opting for to prevent frauds and leaking of customer information from the cloud?
Right? There isn't one specific strategy, right? I mean, there's lots of good practices. I think the point I think Nikunj is trying to make is that we speak about digitization as a secular trend. Thanks to the pandemic, it's kind of just got everyone's fancy, right? So at the back of it, data privacy, cybersecurity are concerns which are not to be taken lightly. In fact, at every point in time, you continue to hear reports about some data being compromised some way or the other. Yeah, so it's an industry. If think about it like that, just as we are spending some time talking about banking as an industry, possibly these fraudsters also think about this as an industry. What skills, what competencies, and how might we try and get go one up? I think it's possibly happening as we speak. In fact, a new thing that has, of late, with all the geopolitical tensions that we've seen around, are, state threats. Yeah, the vectors, threat vectors coming from state-sponsored fraudsters. Yeah, so the game is getting very complicated, and I think at one end, technology could be complicated, right? So you want simplicity, yet safe, and that is a trade-off again, right? So these are interesting times. Yeah. So there isn't one answer that I can give. Yeah, how to prevent fraud? I mean, I wish then we would have all solved it. Yeah, there's lots of things: customer education, beefing up, local risk and control environment, assurance process, third-party audits. Time, a dozen. So many things going on.
So I think the last question we have for today is Dhruv's question. Looking at the trajectory of India's growth, do you think India will be able to overtake China's economy in the upcoming years?
What can I say here? I think our Prime Minister has gone on record, right, where he has put out some aspirations of what he wants, in the next 25 years as we hit our 100th Independence Day anniversary, what kind of nation we want to be. So rather than get dragged into whether we will be bigger than China, when will we get to the 5 trillion economy, etc., I think there is enough and more for us to do to ensure that some of the things that we can do to ensure that, somebody had pointed this out recently, right? If you want to double your economy, let's say in the next 3 or 4 years, you need to have on an average 8% growth. So what does it require for us to be an 8% growth every year kind of a nation? I think there is enough and more for us to do. The McKinsey chairman has gone on record saying that this is not just the decade for India, but it's going to be a century for India. Yeah? So lots of positive sentiments around how we are positioned, how we are poised for growth. I think, I think about this like a plane about to take off. I think we are flattered to deceive in the past. I think something or the other, the plane has not taken off. And I hope that, in the ensuing decade or two, we will have our rightful share in the global world order. I think that is a desire, that's a hope, that's an aspiration, there is some commitment to be able to work towards it.
So I think with this, we come to an end to our talk. I'd like to thank you, Mr. Ram Gopal sir, for taking out time for this session. It was an absolute delight to host you. I would also like to thank the audience for joining us. Before we wrap this up, we would like to be grateful if the audience could fill out the feedback form, which is in the chat box. Uh, the recording summary for this talk will be shared later on, and I think Sir is also going to share that slides he had made.
Yeah, I'll send you the link to that report, Jaina. Yeah.
Sure. Yeah. So we'll attach that too.
Yeah. We don't need to get lost in any copyright issues, etc. So we can take it directly from the McKinsey report.
Sure. Sure.
Thank you so much, folks. I really enjoyed it. I wish each one of you a very fulfilling and happy career ahead. If there is anything that I can do personally, by all means, do reach out to me. You could reach me, either through LinkedIn or presently ram.gopal@barclays.com. All the very best until we see in person. Take care and bye.
Have a good evening, sir.
Thank you.